All right. First, I'd like to thank the mathematics department for having us to present. This is preliminary research by Kyle McGreeth here and Robert Steinstraw. It's on using machine learning methods to value options, and specifically they're going to see whether it can improve on present analytical methods that we have for valuing options now. So it's nice. I'm glad, again, we were able to do this in mathematics because it's a nice where we span all mathematics, finance, and some modern computing methods. So I hope you enjoyed the presentation, and I'll hand it over to you.
Thanks, Dr. Bridget. As he touched upon, we're going to get we're going to present our preliminary results on stock option valuation between Black-Scholes and neural networks. This is preliminary results. It's a work in process, but this is what we have thus far. To get started, a brief overview of what we're going to touch on. We're going to talk a little bit about the background behind the research, give an explanation of stock options, the Black-Scholes valuation model specifically, and then the assumptions of that model. And then we're going to talk a little bit about alternatives to the valuation model via neural networks and machine learning. And we're going to get a little bit into the Twitter data set that we broke down and analyzed with these neural networks and machine learning and the Black-Scholes. And we'll talk a little about the methods, and then we'll wrap up with some conclusions. Okay, to get started, some background. The neural networks have been compared to the Black-Scholes for valuing options before. Hutchinson, Lone, and Poggio in '94, they tested whether neural nets would learn the Black-Scholes model. They definitely found evidence that it could. However, the comparison was done on the prices they simulated, assuming prices behave as the Black-Scholes world. So in their analysis, the neural net could never outperform the Black-Scholes. The assumptions of the Black-Scholes were given, they were valid, and they just wanted to see if the neural nets could actually value options exactly the same as Black-Scholes. So that's kind of what they were looking at. We're doing a little bit of a spin-off look, asking a little bit different of a question. We want to know if neural networks can learn to value real-world options to an extent that is better than the present methods like Black-Scholes. That is, do neural networks have an advantage over established models when applied to the complexity of actual markets? So we're going to release some of the assumptions within the Black-Scholes to try to make it more realistic to actual market activity. Robert's going to talk a little bit about stock options and how they're used and implemented in the markets today.
Yeah, so what we're actually valuing today is stock options, specifically call options. Now, a brief description of what a call option is. A call option is an agreement or contract between a buyer and a seller, giving the buyer the right but not the obligation to buy an underlying security at a specific price, which is a strike price, with a given amount of time. To figure out the value at expiration or the exercise value at any given time for a call option, you simply take the stock price minus the strike price. The zero represents that the exercise value can never actually be below zero due to if the exercise price or the strike price exceeds the stock price, then an investor is not going to execute the contract, therefore making the value of the option worthless. Now, stock options in general are used for hedging for investment portfolios in the industry and also to speculate on certain stocks and securities. So as a call option, you would be speculating that a specific stock or security is going to increase within that given amount of time before expiration, giving your call option more value. Now to talk about the Black-Scholes option valuation. Now I'm going to get into a lot more detail of what it actually is, but a brief overview, it is like the stock option price thing still used in the industry today. So it is, it's very well known and it's still very relevant today. Now to get into the actual components of the formula behind it, CO represents the call option price, and it's equal to the stock price times normal distribution of D sub 1, which I'm going to explain how you get that in a second, minus X, which is expiration, times E, which is the base log, the base of the natural log function, and then raised to the negative risk-free rate times time, times the normal distribution of D sub 2. Now to find D sub 1, you take the natural log of the stock price over the strike price, plus the risk-free rate plus variance over 2 times time. To find D sub 2, you take it equal to the solution of D sub 1 minus the standard deviation times the square root of time. Okay, now to get into more detail about what the Black-Scholes option valuation method is. Again, it was the groundbreaking first of its kind in the industry. it's still very important in the industry today because it's one of the only, it's very solid in academia and in the industry to value stock options. So what the previous equation that I showed you on the last slide is a direct PDE solution for the Black-Scholes. Now, Black-Scholes will exactly predict or will give the exact solution for a European call option with all the underlying assumptions remaining true. Now, this being said, just a brief overview, a European call option and an American call option, the only difference is the European call option can only be executed at expiration, and American call option can be executed any time before expiration. Now, for our purpose, we use Twitter. Twitter is a non-dividend paying stock, which means that the American call option equals the European call option in our analysis.
Okay, getting into some of the assumptions of the Black-Scholes, which are key to the model. First and foremost, there are no market imperfections. So, in other words, the markets are perfect. This is a common economic assumption that is made to make real life more understandable. So it's not that far-fetched. Also, the second assumption of the risk-free rate of return is constant. That's not far-fetched either. Typically, this risk-free rate is derived from U.S. government issued bonds and the interest rates on those. So you'll see later in our data set, we looked at a 3-day time period. So the interest rate on bonds issued by the government aren't going to change in a 3-day period, let alone a year or so. The next assumption is the biggest in the model, which implicates that the stock price dynamics are given by a geometric Brownian motion provided by this equation, where B sub t is a standard Brownian motion, and at least one investor observes sigma without error, which is somewhat applicable. A geometric Brownian motion process only assumes positive values, just like real stock prices. So that kind of, it's very fitting in that sense, but there are some drawbacks with this assumption. Specifically, it's not totally realistic because in real stock prices, validity changes with time, but in the geometric Brownian motion, validity is assumed constant. So this is a big assumption that we're going to try to release with our analysis with our data set coming up, both with the Black-Scholes model and with the neural networks and machine learning. Okay, and then the fourth assumption here is no arbitrage, just meaning that no single person in the market could invest or make money without taking absolutely no risk. Again, it's not that far-fetched. Okay, getting into the alternatives to the Black-Scholes valuation model, we were taking a look at neural networks, and they provide non-parametric relationships or nonlinear. It provides the ability to capture many non-linearity relationships without recourse to any one specific specification of the nonlinear relation. You'll see later in an illustration graphic that we have for our model what this neural network actually entails. So for a slight visualization, you're going to have all your inputs on the left. In our instance, there's going to be 5 inputs. It's going to be the price of Twitter, the exercise price, the risk-free rate, and what else do we have? Implied volatility, lagged. And then they're going to be underlying hidden layers, and they're going to feed into these nodes, and then at that point there's going to be an output of the option valuation. But like I said, that's probably hard to visualize right now. We have a nice graphic later on in the presentation. It's important to note also that these neural networks are not programmable, rather trainable. You feed them data, and you have to provide a certain number of observations for them to make determinations based off that data, and then it processes it based upon that. Okay, and now getting into machine learning as an alternative. Machine learning uses historical data to make informed business decisions. The machine learning algorithms discover patterns in data and construct mathematical models using these patterns, and the models used to make the predictions on future data. It's important here that the difference between the machine learning models and neural networking models in the Black-Scholes models is there's no partial differential equation. There's no exact solution to these. There's an exact solution, but we don't necessarily know exactly why the outputs are coming out the way they are via the hidden layers within the model. Some of the pros and cons of machine learning. The pros, few assumptions are made compared to traditional Black-Scholes, and there's an ease of building predictive models. It takes somewhat relatively low input observations for it to make some predictions based upon those inputs. The cons are that it's data intensive. I mentioned that '94 was the groundbreaking research on the machine learning and neural networking for Lowe, Hutchinson, and Pogge. Up until about 5 years ago, the options data that was available to the public was relatively hard to come by, but recently it has become readily available for further analysis, which is why we wanted to really take a look at the valuation based upon these different assumptions. And also, there's no mathematical solution to validate patterns, as I touched upon earlier, no PDE, so sometimes it's kind of plug and go with that.
Okay, now to talk about our actual Twitter data set and why we used it. We used call options again on July 14th, 2015, this past summer. It's a significant date because there was a fake news release by Bloomberg.com stating that there was a acquisition bid on Twitter for $31 billion. Immediately when investors heard this, they jumped into the stock. The stock immediately jumped by 8%. So at like 11:30, the stock was somewhere below like 38 bucks, and then it gets up to 38 bucks. So it was 8% jump. This increases volatility significantly, which is interesting for us in our analysis because we're going to want to see what Black-Scholes and what machine learning can do at a time where the market is very volatile. So that's what is kind of interesting in our analysis as we move forward.
Right, I mean, with the Black-Scholes assumption that it's constant validity, obviously this is a real-life example of where it's not constant. I mean, a news release to the public is really going to show a spike, and you guys will see in a later graphic here.
And so yeah, so this is the stock graphic as of July 14th.
So as you can see here, I mean, at about around 11:30, there's a jump in the stock price due to the news release. It was an acquisition release, and then the implied validity jumped as well. So we could take a closer look at this. It's important to release the validity assumption. I mean, based upon this, from about 11:36 to 11:45 or so, I mean, there's a drastic increase in the stock price and the implied validity. So that just makes concrete what we were trying to get at with the release of the assumption. So we were only looking at this brown line here. So that's the call option on 7/17. That's the exact day we were looking at. So it's these other prices are for future dates down the line. As you can see, they increased as well, but just not exactly the same. You can see here, there's a kind of nice graphic. You can see, actually when the website appears to go up, then the first tweet about the acquisition and how the market's reacting to it and jumping up so quickly. It jumped from almost 45% implied validity to about 70% within a few minutes.
Okay, so now to talk about our input parameters. So again, we use the call options for expiration date of Twitter for 7/17, which is 3 days before, the 3 days after the news release, the fake news release. So we use the weighted average price for the Twitter stock with between 30-second intervals. The option strike prices, now we chose these option strike prices that were the most heavily traded stock or option prices, strike prices, so that we could really get a good analysis on it. So we used from a range from $33 all the way up to $41.50. They were in between 50-cent intervals. And then so our risk-free rate was, again, it was constant, so we used a constant risk-free rate. Our time until expiration was 3, which was the difference between July 14th and July 17th, plus the fraction of the day left, divided by 252, which 252 is the amount of trading days in a year. And then the fifth input is validity, and Cal is going to touch on more of how we kind of came up with the volatility.
Okay, so yeah, calculating the volatility, that was the big assumption we released, so we needed to do so for both the Black-Scholes and the Twitter data set and the machine learning and neural networks. So obviously one of the big drawbacks is that assumption, and it's not a good assumption because a day with fake news, as you guys saw in that visual, I mean, it jumped up drastically within a couple minutes based on a fake news release. So we used a real-world updating method to calculate the validity. And to break it down, during the first 30-second interval of the day, denote time t, we use observed option price to calculate implied validity. We use the QuantLib, which is a quantitative finance software tool available via online. Moving forward, we use the time t validity as the input to Black-Scholes in our machine learning models for the next time t plus 1 30-second interval. And we kept repeating this process as observation went. So you can see that we used the input in time t plus 2, and so 2 plus 3, t plus 4, we just kept going on and on. Okay, as far as the Amazon machine learning goes, this was kind of the first step in, our hypothesis that maybe we could use Amazon machine learning to value these options. It's somewhat popular for the most part, and we decided to go that route. Some important notes about that was there was a downside to the lack of control in machine learning. Like I said, you choose the number of training observations and the type of output, either continuous or binary. So in our example of our Twitter data set, we used 400 observations for it to train on, and then it gave us our output when we were left with 1,328 observations. There was some ambiguity though with the methodology behind it. We didn't know if it was nonlinear or linear based upon their description on their website. So I believe if it was binary, then it would have been nonlinear, but if it was continuous, it was linear. So you'll see in this next slide here that the results weren't exactly what we were anticipating. As you can see here, the machine learning predicted the Amazon machine learning are in green, with the difference from the actual and in dollar amount and the observations on the x-axis. So pretty much what this is saying is that the Black-Scholes is predicting the option values a lot more efficiently than the Amazon machine learning is during our 3-day time period of the Twitter release. Which was contrary to what we believed. We figured that the non-parametric analysis by the Amazon machine learning would, tend to be more accurate than the Black-Scholes, but that forced us to move forward with our research.
An interesting thing about this really quick is obviously you can see between 400 observations, this is where we suspect that that's where the Twitter or the news release was. So that's when it was most volatile. And so you can see Amazon machine learning kind of went haywire and Black-Scholes was able to kind of stay constant.
Okay, Robert's going to talk a little bit about official neural networks at this time.
So like the abbreviation ANN, artificial neural networks, our model was a 5N1, which means that we had 5 inputs like we discussed before. N is the hidden layers or the nodes. And then we changed that. So the model that's shown on the other page, or on the next slide, it has 8 nodes, but we have a visual at the very end where we can change the nodes and things like that. And then 1 is the output, which would be the option price. Now we want to note that with n sufficiently large, the nodes, then the network can approximate any continuous function uniformly. The output function is linear. And then here's a quote about artificial neural networks: a way to parameterize a general continuous nonlinear function. This is from the analysis of financial time series. And now this is our visualization. So this is what any kind of neural network, they usually have like a web type of visualization like such. So this is our 5 inputs on the left here. And then in between here is where the patterns are being made and things are being recognized. Now this is the hidden layers. And then you can see the 8 nodes, which are the circles in the middle. And then from there, they give us the output, which would be the option price. And that's what we calculate with the neural network.
Okay, so after we ran through Amazon machine learning, we did some exploration in R software that we've been working with quite frequently over the semester. And they had some packages, neural networking packages, specifically NNet, RSNNS, NeuralNet, and FCNNR. We ran our data set through all of these packages, and we got some pretty interesting results, to say the least. So following the results using NNet, the estimation was done via nonlinear least squares, and we got similar results using the following 3 RSNNS and NeuralNet FCNNR, but on this next slide we're going to show a little application of where the NNet results were graphed. Also, we welcome you guys to get on GitHub and check out our code we used in R to maybe make some changes or edits, any input you may have. It would definitely be open and welcome. Okay, so as far as this application goes, is it adjusting or do I have to refresh it? Okay. All right, just bear with me for 1 second. We have to refresh the slide. All right, so if you see here these adjustable sliders on the left-hand side, you're going to see the percent of the sample used for training. So that's going to be the number of observations you're giving to the neural net to train and make observations upon. So on the right-hand side, we have about 20% of the observations used, which was roughly 400 observations in our data set. On the right-hand side, you can see the number of nodes in the hidden layer. As touched upon and as anticipated, as the number of nodes increase, the more accurate the machine learning and neural network. The neural network is going to be at predicting options prices, but as you decrease the number of nodes, it's going to vary with the decrease. So there's going to be a relationship there with that. And then also, if you increase the number of observations, the neural net is able to analyze and make predictions based upon that. It's going to be more accurate in time. So just for a quick illustration of that, as you can see, as you decrease the amount of nodes, it gets somewhat worse, but it's pretty darn accurate. I mean, a lot better than the Black-Scholes at this point. I mean, if you look at the averages here in the top right-hand corner, the average is 79% error and ANN of 9% error. That's quite the difference. So we are pretty happy with these results here. Also, if we adjust the percent of sample used, you can see that there is a drawback specifically there. I mean, if you take a look at that, that's quite the difference between 16.5% and 15.3%.
And I would point out, this is one of the drawbacks with using neural networks. So, you know, it's consistent up until this point, and I'm sure if he moves it to the left, it will go back to where we had it, where it's pretty consistent. But the problem is with, like we said before, there's really no PDE to actually discover what is behind this and why it's doing kind of what it's doing. So one of the drawbacks is if you want to use this in industry, you would have to keep training and then kind of going back and implementing, training, going back and implementing to kind of discover, you know, what's going on and whether it's working or not. So that's kind of the drawback, and that's kind of why we want to go and look at a bunch of different neural networks and see how well they react and see what kind of different observations we can come up with.
Right, I mean, just as you adjust the number of nodes or even the percentage of sampling size, the percentage of the sample used for training, I mean, there's some pretty inconsistent results there, but we don't think that that's a big issue in our analysis. We just need to extend this research further to a bigger data set and see how the number of nodes and the percentage of training is really affecting the option valuation. So we're really excited about moving forward with that in that process. And like I said, further research, we want to use a larger data set. We actually got a hold of some data that we're working with currently, ES options futures. So it's like mini S&P 500 options and futures. And we want to use additional neural net methods. We've looked into most of them on R. We're thinking about maybe engineering our own neural network via R Studio and R software. So that's an avenue we're looking to go down to make our results more robust. And then we're going to compare it to more sophisticated option pricing models to also ensure robustness across the model. And that's pretty much all we have. I mean, we have our contact info up here. Like I said, that link for our code for R is in the presentation, and it's available to anyone to go in and take a look at and make adjustments. And we would be really welcome and excited if anyone would have any contributions to that. Our GitHub accounts and emails, our contact information is on here.
Yeah, and so just to be clear, this presentation is actually up online, so all you need is the URL. You type in the URL, and you can find this presentation at any time, anywhere that you have internet. And so yeah, so definitely take a look at it if you guys would be interested, and also add us on GitHub and things like that. You can do contributions with each other from anywhere in the world. So it's a really interesting thing if you guys would be interested in R coding and things like that.
All right. Well.
So any questions?
Sure.
What would be long-term plan with, like, the sort of research you're doing with this?
That's a great question. Well, I think that we're really trying to find a solution to option valuation that's not based upon these Somewhat unrealistic assumptions like constant validity. I think we're going to try to move forward and we have the ability to compute these types of things. So if we could come up with a model and programming and in software and analysis that could compute these, I mean, there's an opportunity for this to be practiced in the financial markets throughout the world. And so that's really what we're trying to get at.
And something interesting that I don't think we mentioned, but I mean, broker sites use Black-Scholes, so you know they're still using, and they kind of adjust it accordingly. But broker sites like Interactive Brokers and others use Black-Scholes still. So you know you find a more efficient way to price options. Obviously, they're going to use that because it's it's going to be a more efficient thing for the platform. So that's another thing that down the road would be really interesting to do. And also, just showing like the Amazon machine learning, and then Google has their own machine learning. And if we can, really show that like our machine learning or our neural network is better, essentially, or it's pricing it more sophisticated or something like that, that would be kind of interesting. Kind of, let Amazon, let Google know that we put together something maybe a little bit better. So.
The fake news release that created the spike.
Yeah.
Is this like legitimate news companies make mistakes sometimes, or was it like an Onion article? I didn't quite.
I believe the server was hacked. Was that correct?
No, somebody posted something online, and then it was picked up by legitimate news services. So it was
Bloomberg,
retweeted by CNBC, and then they shortly, like 5 minutes later, found out it was fake.
And one common thing, if you really follow the industry, one common thing is you realize that any news site, they want to be the first to react to something. So if they find that they think that there's a credible site or source that releases, they're immediately going to try to be the first one. So, and then obviously investors react to that very quickly, with the news being released.
I should also mention they set up a fake Bloomberg site. So when you went to it, it looked legitimate, like it was real Bloomberg, but it was like Bloomberg.news or something like that. So it was a sophisticated fake news atmosphere.
Do you think there's any hope to use your machine learning and neural nets to work with Fanduel and get optimum strategy?
That's funny you ask. We were just talking about that last night, actually. I mean, just implement that into that. I mean, it's a big business, obviously, and they're trying to regulate it heavily.
It is funny because like last night, my dad over the break, because I showed him all this stuff that we're working on, and he's always doing FanDuel and stuff. He says, well, I'll pay some pretty big money to have you make sure that I have something up to date and
Use these neural nets to make me some money, actually. So I mean, there's promise there. We're really interested in the option valuation at this point, but once we get a concrete, robust model, I think we could apply it to things like FanDuel and other, examples like that.
Volatility would have to be very extreme with injuries.
Yeah, you would think, yeah. Anything could happen in the sports world. So yeah, volatility would definitely be high.
Any other questions?
The Amazon machine learning, is that something that just anybody can go use on Amazon?
Yeah, there's a small variable cost included with analysis, so it's not that expensive. So I mean, you could get on there and run a few models through and get the outputs, but it's marginal at most. It's not that expensive.
And we have that link, and honestly, it gives a really good description on that link about what their Amazon machine learning is. I mean, it's like a 2-minute video, but it really describes briefly of how you can use it for any business, for customer feedback, for things like that. And it's a model already built, so that's what's kind of nice about it, is you don't really have to kind of worry about that. You just use their model.
Given that it's sort of a marginal fee, what's Amazon's incentive to provide this service?
Well, I think it's for business owners and to help drive the economy for the most part. I don't think they're trying to make a huge profit on it or anything like that. It's a really cool and interesting technology and software, and I think they're trying to make that available to the public.
This costs $1.50 to do, but of course it cost Amazon $0. So that was right. But so it is very inexpensive to use.
Yeah, and it's new, and it's gonna, and they think that obviously there could be some potential to use, and if businesses can catch on to this, that it would be a nice tool for them to offer to customers.
Could I just comment, you did some interesting modeling here and comparing results of the theoretical Black-Scholes predictions as well as your approach to the modeling with the neural nets and machine learning. This is the kind of thing that the mathematical contest in modeling often sees. It's an international contest that takes place in February. You can stay here on campus and have access to all of your R programming and do simulations and draw conclusions on the basis of your work. if you're interested, we could try to get a team together for video,
Absolutely.
everybody. Actually, good teams that go together are those who know how to program, those who know how to simulate, those who know how to write well, people who know physics, people who know computer science, people who know mathematics. Combined teams, hybrid teams usually do very well, and it's very interesting.
Oh,
Does
absolutely.
sound interesting.
You're going to lose a whole weekend, though.
I think I can spare it.
Yeah.
Yeah.
So would a actual news report, like a real piece of news, do the same thing to the volatility? Like that wouldn't have changed what happened with the model.
Absolutely. I mean, you can see, at any time, like, you know, there's a new, I mean, just for instance, there's news releases every quarter for, you know, earnings releases, and you can see, like, what that does to the stock. You know, volatility goes crazy, it jumps or it drops significantly. Or, I mean, just for instance, like Valiant, like recently there was that, you know, and they can't really specify what it was really on, but, you know, all of a sudden it drops 15% within a couple weeks. And, you know, that increases volatility like crazy. And so, and that was just supposedly just about a tweet. And so, you know, it happens, and, you know, and that's a pharmaceutical, which is obviously volatile anyways. But yeah, I mean, you see it all the time in the industry where like just certain little news will, you know, make a stock price jump or drop significantly.
With the validity calculation we use, you could apply that to any news release on a particular stock. So yeah, to answer your question.
Is an excellent example. I remember Eisenhower's heart attack, but even better, 9/11. I am still mad at Osama for not telling me.
I wish we all knew, right?
Yeah, right. Yeah, it's, and again, that's, I mean, well, just for instance, just the Paris attacks, you know, and, you know, people may have not have thought of what it would have done, but Monday, you know, the stock market was up, and, you know, so terrorist attacks affected, you know, any kind of like economic things will affect the market volatility, and that's what's kind of interesting about it.
And you can't predict them.
Yeah, well, it's what we're trying to figure out. But no, he's right. I mean, you can't.
In our ES data set, we're going to have FOMC announcements, which is going to provide a lot of volatility.
Yeah, so that's interesting.
Yeah, so like we said, this is pretty preliminary at this point. We just got a hold of a larger data set, and we're going to be able to, you know, draw some more significant conclusions and more concrete conclusions based upon this 6-month span of data we just received. So we're pretty excited to get into that. Hopefully the results are somewhat similar to what we have with our networks, and then I think it's exciting that we're going to try to build our own neural net through R and see how it will react to the data set that we're going to be using upcoming here.
Any other questions?
Well, again, I just want to thank you for letting us come over here and do this, and also Dr. Brigida, because, you know, obviously he's really a huge help with this, and I'm really excited to keep doing this and keep working on this and as we move forward. So if you guys would be interested, you know, definitely keep tabs on what we're doing, because I think it can be pretty interesting as we move forward.
Thank you all.
Thank you.
Very nicely done.